What's good, everyone, and welcome back to the Financial Freedom channel. We are on our free money glitch series #1, talking about portfolio construction and diversification. We will look at some ideas on how to construct an investment portfolio and how to use asset diversification to minimize risk. So grab your notebooks, buckle up, hands and feet inside the right at all times. Let's go glitch this money. So building wealth is dependent on the creation of a portfolio that will meet investor requirements. Portfolio construction is the grouping of financial products that can help an investor achieve their financial goals. The most important step that needs to be taken before the construction process begins is determining an investor's risk profile, as this is what the construction of an investment portfolio is based on. Since this module is based on income generating strategies, we will look at basically two types of portfolios that investors generally want to construct, which are income focused portfolios and growth focused portfolios. Okay, so portfolios that are constructed with income as the sole focus will generally maintain steady performance in nearly all market conditions. These types of portfolios are suited to investors who have an extremely low appetite for risk and are satisfied with consistent income that is relatively very conservative. Okay, this type of portfolio is considered extremely defensive with very low risk of capital loss, and as such will contain a portion of all the asset classes discussed in the previous section. So to break down the different allocations for the portfolio construction, we have to use percentage values for each. So these percentages can be increased or decreased according to the investor's comfort level. Okay, the three asset classes that are suggested for this portion are a cash holding, term deposit investments, and government bonds. So as you can see, the largest percentage is allocated to the U.S. and international government bonds, making up 50% of the portfolio. Government bonds are considered highly secure investments where the government will pay the interest on time and return the principal on maturity. So over the longer term, government bonds have returned an average of 5 to 6%, but the returns vary on the current economic climate and interest rates. International government bonds are also included to help reduce country risk from the portfolio. The second largest allocation is term deposits. So you will remember from the previous section that the government guarantees term deposits up to $250,000. This is also a highly secure investment product, especially if the amount of the investment is $250,000 or lower. The trade-off is that the investment rate is generally lower than bonds and varies according to the current interest rate. Okay, the third and smallest allocation is a cash holding. This portion is expected to return little, if any, return at all when held in a bank account, but should be included for the sake of diversification and access. So as an example, investments in term deposits and government bonds have a set period for investment. Okay, if for some reason an investor needs to access their funds at short notice, breaking either of these terms could result in a financial penalty or loss in interest payments. So by maintaining a cash holding, funds can be accessed instantly and in most cases when required. Okay, so portfolios that are constructed with income as the primary focus with some expectation for capital growth can include some other asset classes that can facilitate this from the growth assets category. Okay, so this type of portfolio is still considered mainly defensive, but the addition of some growth assets does increase the chances of some capital loss, which is the trade-off for conservative growth potential. Okay. The asset classes from the defensive category that are suggested for this portfolio are cash holding, term deposit investments, and corporate and government bonds. Okay. So from the growth category, domestic equities and real estate can also be included. And this chart demonstrates the type of breakdown that can be used for each of the asset classes. Okay. So we can see that 3/4 of the asset allocation contains assets from the defensive category with the inclusion of corporate bonds. So quality listed company bonds generally provide a better return than government bonds, but are still considered lower risk investments than company shares. Okay. So using these asset classes helps protect the portfolio from market volatility, but still provides a steady income for an investor. Then the next largest portion is allocated to domestic shares. As noted in the previous section, domestic and international shares also provide a form of income through dividend payments. So they are a good addition to an income-focused portfolio. Okay. However, the main benefit of adding shares to the portfolio is to gain exposure to potential capital growth to the value of the shares. Okay. Although, this increases the potential for capital losses, the allocation size and equities for this type of portfolio is balanced with the defensive asset class element. So any negative volatile fluctuations in the market will have minimal effect on the value of the portfolio. The benefit of share income is also important here, because almost like a limited hedge, the shares can fall in value in the amount of the dividend payment and still have little impact on the overall portfolio value because of the dividends, right? This gives the investor the opportunity to potentially capture capital gains with some protection provided by the dividend payment. So the smallest portion of the growth asset classes are REITs. Like shares, adding REITs to the portfolio also has the added benefit of an income producing asset with the potential for capital growth. As we discussed in a previous section, REITs and shares aren't directly correlated to each other, meaning that by adding both asset classes to the portfolio, a volatile market will not automatically affect both assets in the same way. Both can be expected to provide income by the way of dividends, but the capital gain or loss components, can operate independently of one another. So it is quite feasible for shares to incur a capital loss for a period where property remains steady or rises in value, adding further diversified protection to an investment portfolio. Okay. So then with growth focused portfolios, they are suited to investors who have a very big appetite for risk and who are very aware that the larger growth potential does come with higher risk, right? Portfolios that are constructed with a growth focused mandate are much more likely to capture large market runs when a trend is in place, right? This comes with a trade-off that when a market downturn occurs, a growth-focused investment portfolio is far more likely to reduce in capital value, as many of the drivers which help the portfolio grow in an uptrend also drive the markets down. So a growth-focused portfolio is going to be made up of growth asset classes like domestic and international shares, commodities and real estate. Okay, the share market has a history of driving economic growth, and a portfolio that is centered on growth should have significant weighing in this asset class. So it's important to remember that some of the biggest rises and falls in economic cycles were driven predominantly by shares or by housing. Okay, so growth potential does come at a significant risk at times when the market and the economy is weak. Okay, now the four asset classes for the growth categories suggested for this portfolio include real estate and commodities, with the remaining portfolios allocated to domestic and international equities. Okay. So this chart demonstrates the type of breakdown that can be used for each of the asset classes. Okay. So we can see that from the chart, a large section of the portfolio is allocated to domestic and international equities. The reason why this allocation, is the largest is because they contain a good income component through dividends. Not only do dividends provide a regular source of income for investors, but they also provide a small hedge in weak market positions, or periods. So, as an example, if a share pays a dividend of 7%, and over the course of the year the share drops in value by 6%, all things being equal, an investor will still be at 1% overall for the year on that share. So it's important to keep in mind that investing in a country's index, such as the S&P 500 or the NASDAQ, through the use of an ETF, can still be classified as part of this asset, right? Indices are a great way to gain exposure to the share market without the risk and effort required to identify individual shares and sectors, and still comes with the benefit of regular dividend payments to the investor. Okay. So as was mentioned in the previous sections, a rising share market generally bodes well for property, as rental incomes and capital appreciation in the underlying assets tend to increase. The capital growth component of this asset class doesn't historically perform as well as equities, but it is slower, in reversing at a peak of the market. All right. So this adds some protection to an investment portfolio in aggressive market shifts. So the income component of REITs also helps add some portfolio protection during negative periods for the same reasons discussed earlier in the equity section. So the final asset class included in a growth focused portfolio is commodities. And this is due to their consistent performance in multiple market conditions, including downturns. A demand for some commodities does not waver due to a falling share market, bringing extra diversification and protection to a portfolio with a heavy weighting of equity. So although diversified, it is very important to understand that this type of portfolio is considered extremely aggressive, as it does not contain any defensive asset classes. Only investors with an extremely strong appetite for risk may be suited to this type of portfolio construction, as large drawdown should be expected over time. Okay, so growth focused portfolios with a moderate income element are suited to investors who have a risk, or should I say have a high appetite for risk, but require a steady flow of income, which helps reduce some of the risks. Portfolios that are constructed with a growth focus and income mandate are likely to capture large market runs when a trend is in place, but continue to provide an income for investors during flat periods and times of market weakness. Growth asset classes like domestic and international shares and commodities are going to make up the majority of the portfolio, with the mix of government and corporate bonds to increase income potential without increasing the risk. Okay, this type of portfolio is going to be made up of mainly growth asset classes like domestic and international shares, commodities, and REITs, with a mix of government and corporate bonds to increase income potential without increasing the risk. Okay, so this chart demonstrates the type of breakdown that you can use for each of the asset classes. So as we can see from the chart, the amount of domestic and international equities has been reduced to include the use of government and corporate bonds. Adding the defensive asset class to the portfolio serves as a protective mechanism in an aggressively falling market due to the reduced exposure of equities, but it still provides a form of income in all market conditions. Okay, the exposure to commodities and REITs are included to basically help mitigate some of the risks, but not limit extra sources of income that the portfolio can provide to an investor. This type of diversification allows the portfolio to continue to grow effectively in a bullish market while still providing a steady flow of regular income from all the asset classes. So in flat markets, the diversified mix of asset classes continues to provide income, while commodities and REITs may still provide capital growth during flat periods for equities. And then finally, in a bearish market, the income from the asset class will be expected to continue, while the asset classes like government and corporate bonds, as well as like commodities, will help mitigate the downside risk that equities and REITs may be exposed to. Okay, so you must be aware that although this portfolio is diversified through the use of multiple asset classes, again, it is still considered an aggressive portfolio due to its high exposure to growth assets. Only investors with a strong appetite for risk should consider this style of asset allocation, as large drawdowns are still likely over time, even with the increased amount of income to help offset it. Okay, it is important for investors to continually monitor and review the asset classes in a portfolio on a regular basis, fine-tuning your investments and ensuring you have the right mix of asset classes to meet your ongoing and changing financial requirements is a vital part of any successful investment strategy. So this finishes off our final section in the portfolio construction. Next, we will introduce you to the scariest way to glitch out the whole system: options trading. Well, we're gonna get your feet wet on how to trade and manage options to not only increase potential income, but also how to protect existing investment portfolios from adverse volatility and market crashes. This is Bradley Barnett. I love y'all, from yours truly, Financial Freedom.